We all know about the unprecedented moves we've seen in the oil market over recent weeks, but what four stocks could benefit if and when normality resumes? Hello, I'm David Jones from Capital.com. I thought we'd do a bit of a different video for this one. I'm going to take a look at four different oil stocks from various parts of the oil business. A couple of names that are pretty well known and two that aren't so well known. I thought we'd just run through some of the facts about these stocks, look on the chart, look at things in a lot more detail and see perhaps where the opportunity might be. As usual, if you're watching this and you haven't subscribed, click on subscribe, support the channel, and we'll continue to push out what is hopefully lots of different and interesting videos like this in the weeks ahead. So let's kick things off. Let's take a look at the first stock, Valero. So US listed stock, part of the S&P 500. It's got 15 petroleum refineries in the US, Canada, and the UK, and 14 ethanol plants in the US, although 8 of these have been closed down temporarily, and 6 are operating at reduced capacity. Historically, it does have a large number of retail gas stations in the US, so you might be familiar with it if you're driving around there. And what's interesting, its earnings, the company's earnings are out on the 29th of April, so we'll have some visibility as to how well or badly it's been doing. It has already come out and said to expect losses of around the $2 billion mark. So the market is already factoring in something of a shock for earnings. I think it's going to be interesting to see how it reacts. The share price recently traded down to a level not hit in around about 7 years. Let's take a look on the chart. So here's the chart of Valero going back to July last year. And you can see pretty much since November, when the shares were about $100 a share, we've seen it in decline. That decline has accelerated into those March 18th lows, trading as low as 30. And I think what's interesting since then, we have seen this recovery. We have these earnings coming out, but the share price has recovered. It doesn't look like much on the chart, but we have seen it bounce back by $20. So it's 60% recovery off those lows, crossed the moving average. Definitely here, April the 6th, came back, retested it. And I do wonder, we may well see some volatility over the earnings, but are we in something of a recovery mode here with sort of these lows, April the 3rd lows, from around about $39.50 to 40, and sort of where the moving average is trading now around about 47. Is that going to be support if we saw the share price under pressure? Looking at the RSI down here, we are heading towards overbought, not there yet. MACD gave a buy signal on the way back up on the bounce as the price moved through 40. So, a year where it has been under pressure, but the story over the last month has been one of recovery. So I think it's an interesting one to watch. The second one we're going to look at, I think a name familiar to many of us, BP. Despite recent falls, it's still the 8th largest company listed on the UK stock exchange. It's got something like 70,000 employees around the world, and it's really present in all parts of the supply chain, from exploration of oil and other fuels, refining them, and delivery, of course, to various forecourt fuel stations up and down the country and around the world. Its results are also due out soon, due out on the 28th of April. Like many other oil companies, it is under pressure to cut its dividend. I think BP has probably been seen as something of a cornerstone of portfolios in recent decades. We see the various ups and moves in the share price, but it has been a solid dividend player, but is under pressure, like many others, to cut this. Let's take a look at its chart. And here's the chart for BP. So if we went back a year, April 2019, the share price was trading just below really £6 a share. And at its worst this year, it dropped as low as about $2.25. So the worst levels, I think, so we've got to go back to the mid 1990s to see BP this low. And as with a lot of these oil stocks, we have seen them bounce back over the last month or so. Despite oil making the headlines and having negative crude oil for May, we have seen the share price bounce back. I've got a 20-day moving average on here. And again, it crossed through at the end of March, held above it for a couple of weeks. We've dipped back below. I wonder, are we going to see it cross over again in the days ahead? At the moment, that moving average is sitting around about £3.20 a share. Fairly mixed signals from the MACD and the RSI at the moment. So we saw, not surprisingly, the RSI go really oversold, came out of oversold around about 250, 270 a share, has bounced back. So I suppose if you wanted to be a buyer for the long term, if you're taking the view, well, this move is overdone, I think there's a couple of things that can be done here. Let's just zoom in. So we could take the aggressive move that we are going to see further recovery from here, and probably an aggressive place for stops would be the other side of those most recent lows, around about 280 a share, or a trade giving it a bit more room, or an investment giving it a bit more room. It's a long way away from where we're trading now, but only going back to those March lows. Those March lows came in around about 220, 225. I'll put a trade on this anyway. Let's split the difference. So we have 285 lows here, 225 lows here. Let me put my stop loss in around about 250. So let's put a sort of medium term trade in on BP, taking the view that the sell-off has been overdone. So I've set this up. I'm going to buy 315 CFDs, contracts for difference. I'm using leverage, so it's around about it's about $1,000 position, buying 315 at £3.13, £1,000 position, I should say. So my margin requirement is just over a couple of £100. I'll put my stop loss in at £2.50 a share. It's currently £3.13. Let's set that up. I think that'd be an interesting one to track as the weeks and the months go on, and we see more normality return to oil. We'll see how that one turns out. Now, one of the reasons we saw the oil price go negative this week was because no one wanted to take delivery. There is a lack of demand, there's oversupply, and there's a lack of storage. And oil has been basically floating around the world in supertankers, which brings us to this Norwegian listed oil company. It's listed in Norway and the US, Frontline. So Frontline is an oil transportation business, 70 tankers apparently at the moment in its fleet. And of course, traditionally, these are used for moving oil around the world. But because of this problem with oversupply and lack of storage, oil tankers have become floating storage units. In the oil video we did earlier this week, I talked about the cost for chartering a tanker has more than doubled over the last month. So not surprisingly, companies like Frontline have profited from this, as you'll see from their share price. So they've benefited from being used as floating storage. But of course, you could say, well, if we do get to more normality between supply and demand, they should still benefit from their traditional business from moving oil around the world. But has the share price gone too far? Is it maybe a short selling opportunity? Let's take a look at the chart. And here's Frontline, the Norwegian listing is what we're looking at here. And you can see just how this has moved. If we go back early March lows, down about 60, the share price has doubled in the Norwegian market because of this shortage of supply, because storage has been at a premium there in the storage and transport business. We've seen the price really rally, pushing back up to those highs from right at the beginning of the year. But I suppose you could take the contrarian view here, that the rally has really been too much. Perhaps it's got over ahead of itself. Perhaps we're going to see normality return to oil. Looking at the RSI down here, we are pretty overbought on the RSI, pushed back up to levels not seen really since this peak at 110, and then we had it overbought again in early January. MACD is still positive, but again is trading at an extreme. So it is bullish. The breakthrough here, it is positive. We haven't really seen that decisive a break just yet through those old early January levels. But as a trader, you might take the view, well, actually the move is a little bit overdone up here. Let's sell short. Let's see if we see some of the euphoria disappear from this market. So if I sell 152 at 117.65 with a stop loss, I'll put my stop at 135. So basically, if it blasts much higher than here, I'm going to get out. The momentum is positive at the moment, but I am just wondering, perhaps it's a little bit overdone. Let's set up the sell. There we go. So we're short. So we can trade these markets in both directions. And again, I think like the BP position, it'll be an interesting one to track to see if we do see some of this euphoria calm down. The final company we look at, big US company, again, should be familiar to plenty of us, Exxon Mobil. Like BP, an enormous company and involved in pretty much all areas of the energy business. Its results are due out on the 1st of May. So quarterly earnings from Exxon Mobil, they're going to be closely watched. Let's see how the market reacts. It is another company that is under pressure to cut the dividend it's paid to shareholders. At the time of recording, on Thursday of this week, we've seen the Norwegian company, the state-owned company Statoil, slash its dividend by 2/3 to shareholders. So other oil companies are going to remain under this pressure in what is an incredibly challenging time. Now, the Exxon stock, before all of this, it had been declining for the best part of 6 years. But is the recent sell-off, has that stretched itself too far? Let's have a look at the chart. So here's the chart of Exxon Mobil. It looks similar recently to BP, not surprisingly, but you can see it had been in decline for quite some time. We go back to 2016, the share price was trading around about $95 a share, recently dipped as low as 30. Let's just zoom in to what's been going on over the last few months. So this is where we are at the moment. So earlier this year was trading around about $70 a share. So more than halved into those March lows that we've seen for lots of these oil companies. 20-day moving average did a good job on the way down of keeping the price under pressure. But again, you can see this recovery pretty similar to what we saw in BP, pushed through the 20-day moving average. That moving average is currently in around 40. Given the strength of the bounce back, the RSI is heading towards extreme. So again, if you thought it was going to recover further, you may want to wait for a pullback. And for me, clearly the big level, $30 a share, these lows from late March. And then after that, around about $35 a share. But I think it's interesting for these major oil companies like oil and Exxon Mobil that we have seen them in recovery mode over the last month, despite the unprecedented moves we've seen in the short term for that May contract in crude oil, West Texas oil, that expired earlier this week. That's it for this update. I thought we'd make it a little bit different and take maybe a longer term view at some of these stocks, but we'll leave things there. So from me, David Jones and Capital.com, good luck with your trading and investing.